Hi everyone. So we'll just record the session for the people who can't attend, and we'll also put it in our YouTube channel for your further reference as well. So the meeting has been recorded. Meeting will be recorded. Hope my audio and video is clear, sir. So can someone confirm, Murli sir?
Yeah, it's clear. Yeah.
Okay.
Yeah, you can
So hi
start the
everyone.
recording.
Welcome to Finsherpa's Mutual Fund 101 webinar. So this is the third time we are conducting Mutual Fund 101 webinar, and the response is actually huge for this webinar. And on a Saturday morning, we have around 23 participants right now, and we are also expecting some more participants to join shortly. So the session is going to be like a brief outlook on introduction on mutual funds and what is the benefits of investing in mutual funds. And we all also know about the differences in different products investments as well compared to mutual funds. And we'll also be comparing it with liquid funds and other stuff. So if you have any doubts, we'll have a discussion Q&A separately later after this session. This is going to be a 90-minute session. So I hope I'll complete this presentation in 60 minutes span, and then later we'll have 20 to 30 minutes of discussion time. At the time, if you have any doubts, you can let us know. You can put it in the chat box, or you can unmute yourself and let us know the details which needs to be discussed. So yeah, I'm Sridevi. I'm a financial planner in Finsherpa. So we'll start with the presentation. Can someone confirm if the screen is visible?
Yes, Akka, it's visible.
Yes, Devi.
Yes. Okay. So today's session is all going to be Mutual Fund 101. So when I say 101, it's going to be like whenever you start with a new chapter, it's going to be introduction. அந்த மாதிரி இருக்கும்போது I think most of the people are comfortable with Tamil. Here and there, I'll use Tamil for easy understanding and reference. So 101 is something which we take introduction as a part. So that's why we wanted to name this Mutual Funds 101. So we hope that we'll be delivering all the introductory part and other stuff regarding mutual funds in the end of this webinar. And you will also be able to understand how mutual fund can act as a very important tool in order to achieve financial freedom. Moving forward, we have planned this session actually in different parts. The first part is going to be the basics of mutual fund. So here we'll be dealing of the back end operation of how mutual fund will operate, how the process which is involving in the back end of the mutual fund, which will help the people, investors like you and me, in order to understand the basics. We'll have to start from the back end operations, right? So what is the basic funder of mutual fund industry is what we're going to deal with this part. What is basically a mutual fund? To put it in a very simple context, mutual funds is like a middleman or a bridge in order to invest in different kinds of securities. In this figure, you will understand that investor is in one side of the end and the other securities is another side of the end. Basically, a bridge is something which connects you to different ends, right? So mutual fund companies or AMCs or mutual fund industry on a whole actually acts like a bridge between the investors as well as the other asset classes which is available. You can directly invest in these asset classes. If that is the case, then that is going to be a direct purchase. If not, if you want a middleman who can take care of your fund to invest in different kinds of securities with a minimal cost, then mutual fund company comes into a great picture. So mutual fund company invest in different kinds of securities like bonds, equities, golds, and other stuff based on the funds which you select and based on the theme of the fund. Basically, it is like one-time bridge wherein you can connect with a lot of other securities. It has different pathways to choose with. Moving forward, how mutual fund works. Now we know that mutual fund is going to be a bridge which connects the investor as well as the other asset classes on the other hand. But what is going to happen internally is that investor will invest and the fund manager will pool their money from all the investors who invest in a particular fund. And the fund manager who's managing a particular fund. Say, for example, we can take a fund A and a fund manager is managing the fund A. He will be collecting and pooling all the money from the investors and he will be investing it in a portfolio of securities or a portfolio of debt or portfolio of gold based on the theme of the fund. He will be investing it and that is called a portfolio. Now, after investing, there is something called as a returns which we will get out of that product, right? For example, if it's going to be a stock, we get dividends. If it's going to be a bond, we get dividend interest. And if it's going to be a gold, it's going to be an appraisal which is involved. So whatever interest and returns which is being accumulated from that portfolio will be again passed back to the investors. So this is how mutual fund as a industry function. So fund manager plays a very important role in a particular fund performance and its not performance as well. Now, before mentioning the other slide, I told you something called as an AMC. What is basically an AMC? AMC is nothing but the full form is asset management company. So as a mutual fund industry, we know it connects the bridge between investors and other investments, right? But the bridge has to be constructed or a bridge has to be dealt and performed by some other person. For example, in the case, we can take a construction company. Construction company has come into a place to construct a bridge, right? We know the bridge is the place, but the construction company is called as an AMC. So basically, asset management companies will act and construct the bridge between the investor as well as on behalf of the investors. So AMCs like HDFC, ICICI, DSP, and other asset management companies, there are around 30 to 40 AMCs right now functioning in India. These people introduce a lot of different funds based on the themes and sectors and other asset classes, and they will collect investments from public, other companies, as even HNIs, and then invest in on their behalf on other products which you choose based on the fund. So basically, asset management company plays a key role and it comes under mutual fund industry. So basically, when you select a fund, you will be selecting under any of the asset management companies which is mentioned. Now, so when we say introduction, there is going to be a glossary section definitely involved, because glossary is something which we need to understand the terminology first. We need to understand the meaning of it first, because there are a lot of terms which we might not know, right? So there are terms like AUM, there are terms like NAV. So we have picked a basic few terms and wanted to just give you a gist about it. The first term which we have picked is asset under management. In short, we call it AUM. AUM is nothing but the total money which is managed by the mutual fund. When I said pooling of the money in between, in 2 slides before, you will understand that there is going to be n number of investors which is involved, right? So these n number of investors will invest whatever their caliber is. For example, some people might invest 10,000 bucks, some people might invest even a crore rupees. So whatever investments which is being made by the investors will be collected in total, and it will be invested on behalf of the theme of the fund, right? So that is what we call it, asset under management. Whatever asset is left for a fund manager to manage, it is called as an AUM in short form. In brief, it's called asset under management. Then there is something which many people might not know is exit load. So before there was also an entry load in mutual funds, but that was being demolished. I mean, that was being eradicated by the AMFI. So entry load was like when you enter, there's going to be some charges which is charged, but that is actually taken away. But what is an exit load is? Exit load is a charge which you pay to the fund house when you exit the scheme. That too before a stipulated period. What is meant by a stipulated period? Exit load is something and the stipulated period is something which is fixed by the AMC and the fund manager together. For example, a equity fund A might have a stipulated period of a year. When I say year, it's going to be 365 days. If I'm entering now, right now, on 17th of May 2025, so and now after a year, if I'm going to be exiting, there is not going to be any exit load which is being
Sridevi, 1
there
minute.
for me.
Yeah, Mr. Gautam has message saying that, Madam, your pitch is a bit fast. Could you please slow it down?
Okay, yeah. Sure. So when I'm investing now, right now, which is 17th of May, and then if I'm withdrawing on 17th of May 2026 or later, because of the stipulated period, which is a year, I'm not going to be charged with any exit load. But if I'm investing right now in 17th of May 2025 in the same fund, which has exit load of stipulated period of 365 days, in that case, what will happen is if I am withdrawing a month later, for example, next month, because of any uncertainty or because of any redemption, I'm making that, because of any uncertainty, I'm making that redemption. In that case, what will happen is I will be charged with an exit load. Sir, can you admit few people, sir? Because there are few people waiting outside.
Yeah, it's done.
Sure, that's so. Because I'm withdrawing before the stipulated period, that is before a year, I will be charged with an exit load. So, what is an exit load? Is something that you are committing yourself with a stipulated period that you will be in that fund within the stipulated period. The exit load might vary from 0.5 percentage to maximum of 2 percentage and not more than that. And it is also dependent on the scheme and the fund name which is there. There is also something stipulated period like 30 days, which is also there for fund like debt funds and other funds. But it is totally dependent on the fund house as well as the fund manager's discretion. So, but you need not worry about an exit load once you enter a scheme for a long-term basis. So that is something which we need to take care of it. Moving forward, the next we are going to talk about is NAV. We all know what is NAV, right? But put it in a very simple term. NAV is something which is actually a measure of mutual funds performances. For example, we will be scored accordingly, right? When we take up an exam, say I'm scoring 90 percentage, I'm scoring 90 out of 100 is what we are telling. So when I say my score is 90, it's the measure of how I did it in my exams. Similarly, how a scheme is performing is based on the NAV of the scheme. So it doesn't also mean that higher the NAV, the performance is in the higher rate, because it is also dependent on when the scheme was introduced as well. Because when a scheme is being introduced, the actual NAV is actually 10 rupees, which is being taken care of. So when you are introducing in a scheme, which is a very new fund, right, which we called as an NFO. So when you enter into a scheme, if you invest 10,000 rupees in that scheme, actual NAV is 10 rupees and you will be allocated 1,000 units. And the NAV will increase or decrease based on the scheme's performances. So you will always have to understand the higher the NAV's performance will also reflect on when the scheme is being introduced. The scheme can be introduced a year before also. The scheme can be introduced 20 years before also. So NAV also depends on the factor based on the scheme's performance as well as based on the scheme's introduction as well. Now, moving forward, the other important thing which we need to understand is asset allocation.
పడుకున్నా ఎట్ట కన్నా పిన్నాని దాని నుంచి ఇది ఏడ్చిన సారీ
Can all the participants can mute yourself so that it won't be a disturbance over there? Yeah. Whenever you have doubts, you can unmute and speak. But yeah, thank you. So speaking of asset allocation, what is meant by an asset allocation is, as I mentioned before, there is something called as a theme in which a particular fund house invests, right? So for example, I'm investing in a fund house of 100% equity. When I say equity, it's going to be 100%. So the asset allocation will be all the funds which I'm investing, all the money which an investor is investing, the fund house will directly go and invest in all the 100% equities. When I say there is something called as a hybrid. So you all know what is a hybrid. Hybrid is a mixture of equity as well as debt. We'll also see the different types of mutual funds available in the later slides, but I'm just giving, it's a combination of, I'm just giving it just now because to explain the asset allocation. So it's going to be a combination of equity as well as debt. So in that case, the fund manager will be investing a portion of amount in equity and a portion of amount in debt. When there is something called as a debt fund, it's going to be 100% debt instruments. In that case, the fund manager will be investing completely in 100% debt. So this is what asset allocation mainly is. So it is actually determined by the fund manager's team what the fund has been decided. So I hope I've cleared all these 4 glossaries. We'll move forward. And the most important thing, all 3 S's which we're going to talk about. So whenever a particular person talks about mutual funds, he will never skip this term SIP and he'll never skip this term SWP. But there is also something which many people might not know is systematic transfer plan, which is STP. So what is an SIP, what is an STP, and what is an SWP is what we're going to talk about in this slide. So when I say systematic investment plan, which is SIP, so many people prefer to do lump sum when they have lump sum amount which has been there with them. If a particular person is earning on a regular basis, he is earning regular income, so he will be only given income month on month basis. In that case, what will happen is you can preferably go for an SIP mode. So SIP mode is something you will determine an amount. For example, you're going to invest 20,000 rupees as a monthly investment. And you will also set a date in which you're going to invest. For example, every 5th, my salary is being credited. So what I'll do is at the 7th of the month, I will be investing. So 7th will be your SIP date. So 7th of that month, your amount will be debited from your bank account and it will be credited on the schemes in which you have selected. So this is what your SIP is. In this SIP, what will happen is you're actually averaging out your investments. Instead of investing in a lump sum mode, you will be investing 20,000 every month. At the year end, you would have invested 2.4 lakhs on a gradual and a staggering manner. In this way, you are actually getting the benefit of averaging out. When I say averaging out, what do I really mean is, for example, the 7th of May, you're initiating this month, okay? Right now, the NAV looks a bit down because of market volatility. You will be allocated with more number of units. But tomorrow, the next month when you're doing, which is 7th of June, the NAV is actually costly. It has become increased because the fund has really performed well compared to the volatile market before. Then you will be allocated with less units. But on an average, even when the price moves or when the price comes down, you will be actually getting the benefit of an SIP when you average out units throughout the journey. This is a major benefit when it comes to SIP. When it comes to lump sum, it's going to be one-shot payment. That is also a recommended strategy when it's going to be a long-term investment. And if it's going to be a short-term goal which you're looking for, then timing the market is very important when it comes to lump sum. But when I speak of SIP, you need not time the market. Either if the market goes up or down, even if the NAV price falls or up, you're going to be benefited with the factoring called averaging it out. So this is how SIP plays wonder. And also compounding is very great when it comes to SIP. So we'll also explain that in the later slides as well. But SIP is a very great instrument for all the people who are starting to get income on a regular basis. And lump sum is something which a particular person like who does business and who does freelancing can opt for. Moving on, we have something called as an STP. STP is something many people aren't aware of. What is this basically is, similar to SIP, there's something called a systematic transfer plan, wherein you will always invest one amount or one lump sum amount in one scheme. Say, for example, scheme A. And then you have to transfer that amount to another scheme. But instead of making a one big lump sum withdrawal, what you do is you initiate STP. When you initiate STP, it's going to be a predetermined amount. Say, for example, 30,000 rupees or 40,000 rupees every week you're initiating STP. So from scheme A, 30,000 will be debited and it will be automatically invested into scheme B. You may ask, what is the benefit which we are getting out of it? This is actually a very beautiful strategy when you wanted to invest lump sum in a 100% equity-based investment. Why? When you ask this, if the market is volatile, because you have seen volatility in the past 1 year or close to 1.5 years because of various reasons like Trump tariff and other stuff, right? So in that time, if you wanted to invest 30 lakhs rupees on a lump sum investment, right? And immediately market falls, it's going to be a huge risk which you're taking. So when it comes to lump sum investment in 100% equity-based funds, STP is a beautiful thing which we will do. What we will do is we'll invest the 30 lakhs in a debt fund. This is a very secured instrument. Once that is being done, you will get an average of 7% every year returns. And once that is being done, every week we'll be initiating transaction of 30,000 or a lakh of rupees based on the market volatility condition. And from an ultra short fund, every year 1 lakh or 30,000, whatever amount which is being set, will be invested automatically in a 100% equity based funds. In this way, we are actually averaging out the importance of SIP which we are doing. And similarly, we are also getting the benefit of having the debt fund returns which is being taken care of throughout this transmission stage. That is how STP is a very beautiful instrument in which we can do. I hope I've cleared the point in STP. If you have any doubts, you can also put it in the chat box, or you can let me know at the end. We can also clear your doubts in the later. So moving forward, we have something called a systematic withdrawal plan. This is a very good instrument when you can focus on your withdrawal stage, or I would like to call it as a retirement stage. So basically, there are two stages. In a brief category, we can put it off. We can call it an accumulation stage and a withdrawal stage. Whenever you are earning, whatever your prime earning ages are, we call it accumulation age. So you earn and you accumulate your savings and investments. And once you've accumulated the corpus and it's time for your retirement, once you have retired, it's going to be a withdrawal stage. That is where SWP plays a major role. Instead of taking one lump sum, you wanted to withdraw monthly retirement expenses of 1 lakh rupees. Then you can initiate SWP for 1 lakh rupees and automatically 1 lakh at when the time is fixed. For example, I need 10th of every month, the amount should be credited from my account for my account. Then 10th of every month, SWP of 1 lakh rupees will automatically come to your account. This is actually a very good plan for a person who need retirement expenses every month-on-month basis. And it also effectively reduces the tax as well when you don't withdraw it lump sum and withdraw it in a very staggered manner. In this way, we are also saving a lot amount in the tax. This is actually a beautiful instrument when it comes for retirement planning. These are the three S which we are most importantly, many people talk about mutual funds. Moving forward. As I mentioned, I told you that I'll be dealing with types of mutual funds in the later phase of this presentation. So this is what the types of mutual fund looks like. I know this is quite overwhelming, but I'm not going to give you all the brief outlook on each and every fund. I'm just going to tell you the most important funds which is available. But I'll just give you a gist of how the classification takes place. The first classification, as you can see, it's based on risk. What is risk is that? What amount of risk you're taking in order to get higher returns, or what amount of risk you are foregoing in order to get lower returns. That is what is based on risk. As you can see, based on risk, there are many categories in which we can find. There is low risk until there is very high risk. This is how they are categorized. And this is purely based on asset allocation on that subcategory which comes into picture. And moving on, based on structure. There are two funds which we have, which is a very important thing which we also have to note it down. One is open-ended funds, another one is closed-ended funds. When I say open-ended funds, you can invest anytime you want and you can withdraw anytime you want. There is no restriction and there is no lock-in period anymore. That is what the name suggests, open-ended funds. When I say closed-ended funds, as the name says, there is a lock-in period. For example, if the lock-in period is 5 years and I've invested right now, until May 2030, I cannot withdraw it. That is what a closed-ended funds is. There is going to be a lock-in period according to the fund manager's discretion. And fear not, there is going to be interval in between if you wish to withdraw. But that interval will happen only once in a year or twice in a year after 2 or 3 years later stage. This is actually something many people might not choose, but some people who says that I don't have an investment discipline, I'm a very particular sure person, I will definitely make redemption. In that case, we'll definitely recommend closed-ended funds because there has a lock-in thing involved. If a particular person is very comfortable in having investment discipline and is making sure that he's not going to making any redemption based on that, open-ended funds is a beautiful choice. And it also has a liquidity factor involved. So that is how we have to categorize on. That is how it's categorized on based on structure. This is very important The fund which you select is open-ended or close-ended because your goals will always depend. If your goal is in the 3 years down in the lane, you might not end up choosing close-ended funds, which has 5 years target. 5 years lock-in period, right? That doesn't make sense. So you have to always choose open-ended funds when it comes to your goals being short-term. If it's goal is going to be long-term, then close-ended funds is a beautiful option which you can opt for. Moving on, based on asset class. This is a very, very important point which we need to understand. As I mentioned before, there are 3 asset classes in which SEBI has categorized. AMFI is also categorized. One is debt mutual funds, and another one is hybrid or balanced funds, and the third one is equity funds. I'm not going to explain all these terms which is being given below because it's going to take a lot of time and it's also too much complicated. Since we are also targeting on introduction of the mutual funds right now in this webinar, I'm just going to give a gist on it. When I say debt mutual funds, under debt mutual funds, we will be investing in 100% debt-based funds. It's going to be government securities, it's going to be bonds, it's going to be very less risky, as well as it has also given you very less returns. For short-term parking for emergency purposes and other stuff, we can opt for a debt mutual funds. Or a person with very less risk profile, we can opt for a debt mutual funds. And a person who wants to withdraw for retirement expenses, debt mutual funds is a very excellent option to choose. For other reason, who has a caliber of taking a lot of amount of risk, and he's also targeting a long-term goals, debt mutual funds might not be a very good option. For that case, there is something called as a hybrid as well as equity-based funds. Speaking of hybrid funds is actually in between these debt and equity. It has an exposure of debt. It also has an exposure of equity. But the percentage in which the debt and equity composition is being there, it is actually based on the theme in which you are selecting. There are multiple number of hybrid funds which is available. It has composition of around 20% in debt to 80% in equity, to going up to 80% in equity to 20% in debt as well. We can select based on what your risk profile actually tells you. So that is how a hybrid is actually useful. Hybrid is something which we can recommend if your goals are short term or medium term and you're taking enough amount of risk and you are capable of taking only enough amount of risk and you fall under a balanced risk profile or a conservative risk profile. That's when hybrid plays a major role because it also has a return and growth element of equities as well as a stability element of debt mutual funds. Then, moving ahead, we have equity mutual funds. So under equity mutual funds, we also have different subcategories. But when I say equity mutual funds, you have to make sure that this is only going to be in 100% equities. When I say equities, it's going to be 100% in stocks. The equity mutual fund, a lot of subcategories that also has based on the themes in which we select. So basically, whatever equity mutual funds has been there, based on the theme they will be investing, but it's going to be 100% equity-based mutual funds. Sorry, 100% equity-based allocation. So this is going to be a little higher on a risk profile side and also a little higher on a return side as well. This is type of funds which we can recommend to persons like who is capable of taking a lot of risk and whose investment horizon is more than 5 years or more than 3 years. In that way, whatever risk which we are taking, whatever volatility in the market will be stabilized and he will be rewarded with a larger returns. So this is what, based on asset class, we have 3 main important subcategories. For every person who wants to invest, risk profile analysis has to be done and based on which we will be allocating funds on this categories. And moving forward, we have based on investment objective. This is something which we have to focus on. If your investment objective is growth, then we have to recommend growth-based funds like equities. If your investment objective is, I need regular income out of it, then we have something called as IDCW schemes. Under what all mutual funds you see, there are 2 options, growth option, IDCW options. So if your particular investment objective is, I need regular income out of my mutual fund, then you will be provided with income when you select IDCW option. If your investment objectives, my mutual fund, if I want money tomorrow, then I need that money, then liquidity is your main investment objective, then debt mutual funds comes into picture. If your main objective is retirement, then basically we'll be recommending investments based on that. There is separately retirement funds also available in mutual funds. And if your investment objective is, I'm going to just invest in mutual funds just for tax saving purpose, then ELS is a beautiful option, which has 3 years of lock-in period and tax saving of 1.5 lakhs under ATC. So this is how investment objective classification happens. The last one is based on specialty. We have multiple factors. So actually there will be correlation with all these categories, but based on specialty is what is the theme in which they're investing and what is the specialty of these funds. For example, index funds. When I say index funds, they will completely invest in the index. We have Nifty 50, we have Sensex 30, we have Nifty 500, we have Nifty 100. So these funds which actually directly invest in the index and not in any other fund categories. When I say FOF or fund of fund, what is this category is? They will be investing in different mutual funds itself. That is what is fund of fund. But they will pick 2 or 3 mutual funds and they will be investing. So if you want to invest in 2 or 3 mutual funds, but you don't have that much of investment capability, then you can invest in FOF and gain that return of 3 mutual funds which you wish to invest. That is what called as FOF. And there is something called as a commodity. What is a commodity is? Commodities like gold, silver, and iron and other stuff. If you wish to invest in gold, but not directly, then you can invest in a gold fund. That is what is a commodity-based fund. And there is something called as an asset allocation fund, wherein asset allocation will be discretely given, and this is where you will be investing. For example, it will be 30% in debt, 70% in equity, and based on that, there will be investments taken. And as I mentioned before, exclusively we have retirement as well as children-based mutual funds, specially made for children as well as retirement. It's going to be kind of overwhelming to understand all these concepts, but there are even more subcategories underneath it, which I did not discuss. But these are all types of mutual funds which is available. There are around 3,000 plus funds available in the market. But it takes a lot of energy to understand it. And it also has to do an analysis which we run and we find out the best of funds to give to investors. Moving forward. Now, Sridevi, you have to tell me a main category in which we can understand. I don't want all these subcategories. If that is the case, please understand this chart. This is more than enough to understand what all type of mutual funds are available. As you can see in the left, there is something called as a passive strategy. What is meant by passive strategy? Index fund is a classic example. When a fund manager invests in an index fund, what he will do is he'll just put it in an index and he'll aram se rest. He's not going to do anything unless and until there's going to be any changes in the index equities available. So that is a passive strategy which we are going to invest. Under passive strategy, the expense ratio is the least. There's not going to be any fund manager's job to do. He'll just put it in an index and then he will aram se rest. On the right, you have active strategy. What is an active strategy is, apart from index fund, apart from gold fund and other commodity fund, what all funds which is available will fall under active strategy, wherein the fund manager will have to take discretion. A fund manager will have to take decision on what all funds has to be selected, what all equities, what all debt categories has to be selected. He will work on it on a regular basis. That is called as an active strategy. Here, the expense ratio will be higher. There is something called as in between, which you can see, which is called as a smart beta. These smart beta funds are getting popular in 5 years before. Before that, we are not even aware of what is smart beta. This is the beautiful choice wherein it has a portion of passive strategy and a portion of active strategy involved. This smart beta funds, like for example, Nifty 300 Momentum 50 funds, wherein there is an index fund and there is also a strategy involved in it. So that is where smart beta comes into picture. It uses both passive strategy as well as active strategy and combine it and gives you a greater returns. So this is one of the booming category and we also wanted to like you to know about it. So that's why I put it in a slide. Moving forward. Many people will ask us, what is a capital gain which is involved? That is the most important aspect which many people have to understand before investing because it is your hard-earned money. And what is the capital gain which is involved for the returns which you are gaining from the mutual fund is something which you need to understand. When you invest in a mutual fund, there are two types of gains which you need to understand. One is unrealized gain, the other one is realized gain. When I say unrealized gain, until and unless you come out of the mutual fund and redeem and come out of the mutual fund, whatever gains you accumulate, whatever figures which you see as a returns is called unrealized because you're not yet withdrawn. And that amount has not been taken away from the fund, right? So that is called as an unrealized gain. And no mutual fund will charge tax on you for the unrealized gain. But once you make a redemption and come out of the fund, that's it becomes a realized gain. For the realized gain, capital gains will be charged. What is a realized gain? How will you ascertain this? If I'm investing 10,000 rupees right, and 3 years later, my 10,000 rupees would have increased to 30,000 rupees in a mutual fund. Then 20,000 rupees is the capital gain which I have been gaining out of the mutual fund. So that is what we call as a realized gain. So when I sell it off and when I come, I'll be getting all this 30,000 rupees. But when I'm filing for my returns, I have to pay taxes on this 20,000 gain, which I have been taking from the mutual funds. So this capital gain will be taxed based on the categories which is mentioned over here in this table. There's going to be comparison before and after. I'll just talk about the after because before is a whole picture right now. So when I say after budget 2025, we have all these categories in which it's been targeted. Let's focus on two important categories, which is debt mutual funds and equity mutual funds. When I say equity mutual funds, there is going to be a period of holding which is important. For example, capital gains is being categorized into two, short term, long term. When I say short term, for equity based mutual funds, if it is before a year, it's going to be short, before 12 months. So in that case, if I'm investing right now and I'm taking the money 3 months later, it's going to be a short term capital gain. So in that case, you will be charged 20% on the capital gain. When I say 20%, in my case before, if I've invested 10,000 rupees and my capital gain is 12,000, my capital gain is 2,000 because I'm redeeming 12,000 bucks. So for that 2,000, I will be charged 20%. In the before scenario, we talked about long term. So before I've invested 10,000, I waited for 3 years. So anything above 12 months is going to be long term, right? So in that case, for the 20,000 gain from the 30,000, I'll be charged 12.5% as a long term. But there is a beautiful catch over there is for every month, you get an exemption of 1.25 lakhs. So anything over and above capital gain of 1.25 lakhs is where I need to pay tax. So that is what equity-oriented mutual fund tells us. So for simple terms, if you want to understand, below 12 months, it's 20%. After 12 months, it's 12.5%. But remember, for long term, there is an exemption of 1.25 lakhs every year. So that's where SWP plays a major role instead of withdrawing on a lump sum basis. And now, speaking of debt. So for debt, before it was 36 months as category for short and long. Now they've actually reduced to 24 months. So before 24 months, it's going to be on marginal tax rate, whatever tax slab which you fall under. After 24 months, it's also going to be in long term. And that is also will be taxed on your slab rate. So basically, whenever you say debt mutual funds, you will be taxed with marginal tax rate or tax slabs. So this is what you have to understand. Now, there is a benefit in which we will be getting next year. What happened was in the budget, there is also something which Nirmala Sitharaman, our beloved finance minister, told was until 12 lakhs, you will not be paying any tax, right? The returns from the debt mutual fund also falls under this category because it falls under the ITR. If your total income as well as the capital gains from the debt mutual funds is below 12 lakhs, you need not pay any amount of tax. That's why we always choose after retirement SWP from a debt-based mutual funds because it gives you enormous tax benefits. So this is what capital gains looks like. So whenever you are planning for redemption, from our Finsherpa's end, we'll always give you this is the notional capital gain will be charged. And this is something which you need to plan ahead whenever you are filing for the taxation. Moving forward, this is something many people will ask. What is actually a difference between regular plan and a direct plan? So basically, as you all know, most of the clients are from Finsherpa already. So we provide regular plans because we are a mutual fund distributor. When you invest through us, that comes a regular plan. We are a distributor and we will invest to the AMCs on behalf of you. But when it is a direct plan, you will directly invest in a AMC. So this is the main difference when it comes to regular plan and a direct plan. But if you wish to choose an investment in a direct fund, you have to ask yourself these three questions in order to choose direct funds. The first one is, can you do in-depth research yourself? If yes is your answer, then you may go ahead and choose a direct fund. Why? Because doing a deep research with funds involving around 3,000 fund categories in India, it's quite a big task. If you're ready to take that risk and if you're ready to do a research which you can do and DIY your investments and invest, you can definitely go ahead with investing in a direct fund. The second thing is, are you okay losing money due to poor choices? Because sometimes whatever decision which you make might go wrong as well. If you're comfortable in accepting it and understanding it is a process, then comfortably you can opt for a direct fund. The third important question is, will you be comfortable without simple tracking? When I say tracking, a review is very, very important when it comes to investment. Every year, we will be providing a year review or a quarterly based review based on the fund which you are ready to invest. But in a direct fund, you are the person who will be responsible for this review and tracking involved. If you're comfortable in doing that and you can spend some time in tracking and reviewing it, then definitely you can opt for a direct fund. If your answer is no for all these three questions, or if any one of this question, please consider regular mutual funds apart from direct funds, because under direct and regular, there is a major difference of guidance which is involved from a regular mutual fund provider like us. Because we'll have a complete taken care of your reviewing, your fund selection, your processing, operations, everything. But in the direct funds, you have to DIY everything. You have to understand each and every fund and do. If you're willing to do it, if you're willing to take that risk and energy and do that, then definitely you can go ahead and select a direct fund and operate it. If you say, I'm going to say no for any of this question, please consider doing a regular fund. This is going to be a major difference between direct and a regular fund. The next slide will also tell you beautifully what is basically a difference between a direct plan and a regular plan. In the left-hand side, we can see a direct plan has a benefit of low expense ratio compared to regular. And similarly, the NAV will also be higher because of the low expense ratio. And similar of these two factors, the higher is going to be the return. But I'm okay with foregoing this because if I'm going to be choosing a regular plan, there are three things which is going to be taken care of. You're going to get an expert advice from the other regular plan providers and from Finsherpa as well. And it's going to be a very smooth process because a regular plan, an operation part will be completely taken care of, like account opening, investments, purchase, redemption, everything will be taken care of smoothly. And most important factor is monitoring and tracking of funds will be taken care of a regular plan under a name distributor. So it is always important to understand the pros and cons before you're selecting it. So this is what both the plan has its own pros and cons. But understand the differences. If you're ready to do it on your DIY, please do it. But understand it also comes with the cons. Similarly, if you want your process to go very smooth and smooth and sailing, and then you can choose for a regular. This is what it's a basic difference between direct plan and a regular plan. Now, since I've already covered all this part, let me talk about what all the benefits of investing in mutual funds. Basically, as you can see, many people out here have already invested in mutual funds. For people who are new to this thing, I'm not sure what is going to be a benefit in investing in mutual fund. The first and foremost thing is, we'll start from here. It's going to be flexible investment tenure. Basically, unlike FDs or unlike NPS, which has a lock-in period, it's not going to be any lock-in period unless and until you choose a close-ended fund. So your investment tenure is very flexible. You can invest today and tomorrow you can withdraw it. So based on your target year, say my child is 2 years old and I'm going to be targeting my child till 18 years and I need a corpus of say 25 lakhs to 50 lakhs. You have enormous years of 16 years of investment. It's very flexible. You can start doing anytime you want and withdraw anytime you want. It's that flexible when it comes to mutual fund. And the second most important point, it's very convenient and hassle-free because the fund manager will take care of your funds. You need not work on investing in direct stocks or direct gold or direct bonds. Need not go and search for different websites and do it. A fund manager, if invested, will take care of your fund, very convenient, and it's very hassle-free. The third important thing is minimal paperwork. Trust me, even I have not written any forms right now. So basically, it's going to be no paperwork or minimal paperwork. Everything has been done online. Even a person sitting in Dubai and person sitting in Bangalore can invest in Finsherpa through Chennai's office because it's all going to be online. So there is no paperwork or minimal paperwork involved. And the most important factor, as I mentioned before, the importance of SIP. SIP actually assures you power of compounding. That is a beautiful thing. And many people also say compounding is like the eighth wonder of the world. So compounding plays a huge role, and no other investment avenue gives this SIP element, unlike mutual funds. And manages inflation because inflation is currently 5%, which we are considering. But if you invest in AFD, it's going to be 6.5 to 7%. And after taxation, it's going to be very less returns, right? So mutual fund, especially 100% equity-based funds, will give you more returns, and it also manages inflation for you in the long. There is also taxation benefits when you choose ELSS fund. And the most important thing is these are all safe and very transparent because this is all guided by AMFI and as well as SEBI. And what all things fund manager does, has to release a statement for doing it. And every time you do, you can transparently see what all investments he is also doing as a fund manager. He or she is also doing as a fund manager. So basically, these are all benefits which is involved in investing in mutual fund. Moving forward. Now we are actually moving for the second part. I hope I've cleared all the introduction part, the basics funda of how mutual fund operates, the back-end operation and other stuff. But now, let's talk numbers now. So it's going to be kind of a numeric session, but I'll make it short. But you will understand how you can actually invest based on your goals. So that's what it's going to be. I'm taking a classic example. This is what we give you for a retirement as well. So I'm considering your current age is 35. This is something which we do for each and every people because retirement is a goal each and every people have in their lifetime, right? So current age is 35. You wish to retire at the age of 60. And I'm taking life expectancy, the highest value, which is 85. So now you have 25 years for your retirement period, which is starting from 60 till 85. Now, as you can see, the saving window is also 25 because you're starting at the earliest. So right now you're starting till 60, you have your retirement age to be taken care of, retirement expense to be taken care of. I'm assuming a lakh rupee for a couple. So 1 lakh rupees in today's value. And if you take it on a year basis, it's going to be 12 lakh rupees into 12. Now, this is what your retirement data looks like. Now, after calculation, what will happen is we have to consider 5% inflation rate. Why? Because today's scenario, 5% is inflation rate we are taking care of. Actually, it is only 3.5 to 4%, but we are working on a conservatism basis. That's why 5%. So, as you can see, in today's value, 12 lakhs per year would have become 40 lakhs 63,000 when you retire at the age of 60. And there is something called as a 2%, two rates of returns over here. The one is pre-retirement. As mentioned before, since the investment horizon is huge, we can choose 100% equity-based mutual funds. So when I say 100% equity-based mutual funds, I'm taking conservative rate of 12%. At least minimum of 12% your equity-based mutual funds will give you. And there is something called as a post-retirement. I also mentioned this clearly in a debt mutual fund section as well as in the taxation section. When I say SWP, we always look in forward in a debt mutual funds. So I'm taking very conservative return of 7% in that case, post-retirement. So considering all these scenarios, assumptions which we took, the corpus which needs at the time of retirement is actually 8 crore rupees. As you can see, the numbers might be overwhelming, but you're starting very early, which is 35. That's why for 1 lakh rupees in today's value, which you will be withdrawing 25 years later, month on month basis, you need to save nearly not even half and below that itself, just 42,700 rupees as an SIP value. You wish to do as a lump sum, it's going to be 47 lakhs now and you invest it and don't make any redemption and withdrawals and you leave it for 25 years, that 47 lakhs would have become 8 crore rupees when you turn 60. So as you can see, you start with a SIP of 42,000, but you can withdraw nearly a lakh rupee equivalent in today's value for 25 long years. So this is how a basic retirement goal looks like. Moving forward, we have something called as a children education. That is also most people's goal will be. So I just wanted to give you a gist. This is how practically we also do children's education. We are taking 50 lakhs of corpus in today's value and also assuming your child is 2 years old, right? And the target age which we are setting is while they go to college, which is 18 years. So we have 16 more years to achieve. So it's going to be a long-term journey, right? So similarly, I'm taking 5% as the inflation rate and rate of return is 12%. If that's the case, today's 50 lakhs after 16 years, considering 5% inflation rate, would have become a crore rupees actually, because inflation is at 5%. So the amount is actually doubled in 16 years. As you can see, once again, there are two ways to achieve it. One is a monthly investment mode, another one is a lump sum mode. When I say monthly investment mode, if you're starting today and 16 years, you are investing 19,000 bucks approximately every month, you will be providing your child with a crore rupees for her or his education. If I'm opting for a lump sum, it's going to be 17 lakhs 80,000 rupees if you invest today as a lump sum amount and you leave it unattended, sorry, not unattended, monitored and tracked and without not making any redemption for 16 long years, then that 17 lakhs 80,000 is going to reap you a crore rupees when your kid turns 18 years of age. So this is how children education plan will look like. So based on these numericals, some people might feel the overwhelmingness, or some people might say that, okay, this number looks promising. So there can be different scenarios in which we can work on. But according to all this, one thing which we can understand is earlier you start, the better the investment goal can be achieved. So that is what we can end up doing it. Now, since we saw all these numbers, let's just get into comparison of this or that. Anytime when you choose something, there will always be two options which you want to choose, A or B, right? You'll always have these pros and cons listed out, okay, this option or that option. Then you will end up choosing one option. So why only mutual funds? We have to make a comparison, right? So that's why we are giving you options, this or that, and we'll also tell you what is a pro and con in both of these options so that you can make a wise decision out of it. So we are entering part 3, which is this or that. The first one is under mutual fund, you might have a confusion of whether SIP or lump sum. The most important factor is, apart from all these things which is given in a table, how you are being paid, how you get your regular income source. If you're a business person, if you're a freelancing person, if you work under somebody, that is where it plays a major role in making SIP or lump sum. Why? Because if you are being paid regular intervals, say monthly or fortnightly or in a quarterly basis, then SIP can be a major thing. If you are not being paid by the employer, it's going to be you work on your own, you are an employer, you are a freelancer, then lump sum investment can be a great option to choose for. So based on the frequency in which you get your regular incomes is where your investment pattern also does. But apart from the basic thing, there are few comparisons which we can work on. The first thing is the frequency in which you are making the investments. When I say in SIP, the investments is going to be on a regular intervals. When I say lump sum, the investment is going to be one-time single payments every now and then. The volatility, if you say under SIP, it's going to be very less because you're averaging out your investments. As I mentioned before in the advantage of SIP, as you can see, the averaging out plays a major factor under SIP. But when I say lump sum, the volatility is huge because once you make an investment of a lakh rupee or 2 lakh rupees under lump sum, if the market goes down, then at that time, their volatility affects much. But over a long-term period, the volatility will be stabilized. But initial stages, you might feel the kick of volatility when it comes to lump sum. Then, under cost of investment, as you can see, SIP is a very lesser cost of investment. So, due to rupee cost averaging, because you're investing 10,000 or 20,000 on a month-on-month basis. Under lump sum, the cost of investment is actually higher. So, basically, you will be investing a lump sum of 20 to 30 lakhs rupees, and the cost which you are bearing, which is expense ratio, it's actually higher. Compared to the investment size, SIP will always have a low investment size compared to the lump sum investment, because in lump sum you're paying single shot of higher value, right? And when you speak of risk appetite, a person with even lump sum capacity can go for a SIP when he has or he or she has a very low risk appetite, which is low to moderate. But a particular person who has a very good high risk taking capacity and also has a capability of both SIP and lump sum, since he has a higher risk taking capacity, he can opt for a lump sum investment. And now, most important topic is, speaking of investment horizon, it is actually preferred for lump sum investment to go as per long term thing, because lump sum investment is usually preferable for long term goals. But when I say SIP, you can opt for short term as well as long term. So these are the comparisons which we can do for SIP and lump sum on a theoretical purpose. Now, there is something many people have a doubt of: what is the difference between actual SIP and a top-up SIP, right? So actually, in normal SIP, the amount is fixed, which is if you are investing 10,000 rupees every month, you're not going to increase SIP. You're going to be having the same actual SIP of 10,000 every month. But in case of top-up SIP, it's going to be 5% increase or 10% increase, whatever top-up you can choose. You can also choose 20% top-up also based on the fund and based on your salary increase. Now, we wanted to give you a classic example on how this top-up SIP has enhanced your growth. For example, I'm selecting ABSL Frontline Equity, which has 10,000 installment amount, monthly frequency. Now, what I'm selecting is every year I'm increasing it by 10%, right? So this month I'll be investing 10,000, and till this year I'll be investing 10,000 rupees. But the end of the year, my SIP will go from 10,000 rupees to 11,000 rupees, because I'm increasing it by 10%. And next year it will go once again by 10%. So that's how I'm planning it based on my salary increase. Okay. In that case, as you can see the comparison, if this is going to be 0% increase, that is no top-up SIP involved, then the SIP investment cost comes around for 10 years is 12 lakhs 10,000. Okay. And as you can see, the growth is actually 16 lakhs 33,000. Now, I'm increasing it by 5%. Okay. The investment cost is actually raised to 15 lakhs. But as you can see, the growth is actually 19 lakhs. And the enhanced growth is actually 5 lakhs increase. And the percentage is 20% increase just by increasing 5% of your top up. And as you can see, if you're increasing it by 10%, you're investing 19 lakhs in total. But as you can see, the growth amount is nearly 22 lakhs compared to the normal SIP which you're choosing. And the enhanced growth is nearly 47%. And if you're increasing it by in an average 15%, because you get hikes and other stuff on a regular basis, and you're taking 15% as your top up, then you're increasing your investment by 24 lakhs. But see the growth enhanced percentage, which is 80% of your. So just by increasing 5% or 10% or even 15% of SIP, you're actually gaining more and more on it, because compounding effect also plays a major role, and you're also gradually increasing your SIP value. So always prefer top-up SIP when you are very sure about your appraisals and when you are sure about your income increase. So always prefer actual SIP when you wanted to know, okay, I'm okay with going standard amount, you can even choose with an actual SIP. Everything, there is a pros and cons involved in it. But remember, whatever SIP you are committing, it need not be a burden towards you at the end. It's going to be something which you do out of your own will, and it should be something which is comfortable in doing and not a burden to you. Next, something many people ask is, what is the main difference between liquid fund and a savings account? Instead of putting in a liquid fund, I just can invest in my savings account, right? The major difference is under savings account, you will be getting only 3.5 to 4% as a return. But in a liquid fund, you will be getting 7% as a return. Even with post taxation, as you can see, the return is comparatively huge compared to the savings account. But the main category is under savings account, you can withdraw anytime if you want. Now, being GPay and other stuff, which is being very liquid, you can actually take your amount whenever you want. But under liquid fund, one thing which you need to concentrate is if you need fund immediately, you have to initiate a transaction 3 p.m. before in a business day, and your amount will be credited in your account tomorrow 11 a.m. This is the only catch when it comes to liquid fund. Apart from this, the growth-wise liquid funds performed really better. If you can say that, okay, I'm okay with taking liquidity on a T plus 1 day settlement, then you can definitely opt for a liquid fund compared to the savings account. Under savings account, you will be only provided with 3.5 to 4%, but in the liquid account, you will be provided double that. So that is what a comparison is. If you're okay with that liquidity being allocated to you a day later, then you can definitely opt for a liquid fund compared to your savings account. And one more many important question is people ask is, okay, liquid account and savings account is clarified. What is the main difference when it comes to debt fund and a fixed deposit? So under fixed deposits, we only get 7% if you are not a senior citizen. If you're a senior citizen, that is a different picture. You might get till 8 to 8.5%. But on a normal term person, you will be getting 7%. And there is also taxation involved. But I'm comparing this with a dynamic debt fund, which gives you 9.75%. And it is also highly liquid. Some of the FD will carry pre-closure charges, and there will be forms which needs to be filled for closure in case of any emergency which you need to withdraw. But in case of emergency, there is no need for any form filling or nothing involved, no procedure when it comes to debt funds. So you have to initiate a transaction and then you will be credited the next day. So that is how liquid it is, and that is how your interest rate is also comparatively higher compared to the FDs. Even after post taxation, you can see the interest amount is actually huge compared to the FD. So this is what is the difference between FD and a debt fund. Now, this is something which many people will ask. What is the comparison between PPF, which is provided by the government, and ELSS mutual fund? Because both of them has this taxation benefit of 1.5 lakhs under ATC, right? But under PPF, the rates of return is comparatively less, which is 8%. But under ELSS, the scheme return, I'm taking a classic example of Canara Robeco, which gives you 16% rate of return. In both these things, you are investing 8 lakh rupees. And as you can see, the scheme return over here in ELSS is 30 lakhs, whereas in PPF, you're only getting half of it, which is 15 lakhs. So PPF and ELSS both has this thing of ATC deduction, but comparatively return-wise, scheme-wise, ELSS is performing better than PPF. And one more major advantage when it comes to ELSS and PPF is ELSS has a lock-in period of only 3 years, whereas PPF, it has a lock-in period of 15 years. Considering ATC is something which you are focusing on, that 1.5 lakhs tax deduction is something you are focusing on, then ELSS is a beautiful option compared to the PPF. Since it has a very less lock-in period as well as the scheme performance is tremendous compared to the PPF. Now, we have seen this or that. We have come to a final part of our investing. So now we have talked a lot about investments, this or that, and other stuff, and a lot about the back-end operations as well. But I wanted to conclude this by just telling you what are the golden rules of investing for a particular person who is new to investments. Or even if you are a good investor, you need to understand these golden rules to stay committed and disciplined towards your investments. This is completely based on the behavioral finance. It's completely based on how your behavior is towards money. So I just wanted to conclude this session with this golden rules of investing. The final part of the session, golden rules of investing. As I mentioned, I will be dealing about this power of compounding thing SIP at the end of the session. I just wanted to throw you this number because it's a very important number. Understanding, staying committed and disciplined will actually reap you a lot of benefits when it comes to investing. So as you can see, I've taken a classic example of you investing 30,000 every month at a 12% rate of return. This is called 8-4-3 rule. So what is the 8-4-3 rule is? For the initial 8 years, it's going to be very struggling period. Like you will not see returns. You might see volatility here and then. Now all this red thing happening, green thing happening, everything goes on. But you are staying committed and disciplined, and you are investing 30,000 every month at 12% rate of return. As you can see, it will take you 50 lakhs of achieving that for 8 years for the first year. First session, which is your investment is 59% towards your portfolio and your return is only 41%. Okay, that's going to be very tough 8 years. And next, for this 50 lakhs to reach another 50 lakhs, it will only going to take you 4 years, nearly double the amount. So for this 50 lakhs will become a crore rupees. If you stay invested, committed the same 30,000 bucks, it will take only 4 years for you reach the other 50 lakhs. And as you can beautifully see, it will only take you 3 years for reaching from 1 crore to 1.5 crores. And when you see at this period, at the end of your 8-4-3 rule, your investment value is only 20% and your return value is nearly 80%. So whatever accumulated, for example, you've accumulated a crore rupee at that time, 20 lakhs is what you have contributed. 80 lakhs is what your compounding effect has brilliantly done for you. So as you can see, as year passes, at nearly 20 years down in the lane, for example, if you're planning your retirement at 35 and you're expecting your retirement age is 60, the next 20 years later, when you are at your 55, every year 50 lakhs will be added to your portfolio. And you can see at the end of 24 years, when you're approaching your retirement, whatever you're invested is only 6%, but the return is nearly 94% of your. That is how rewarding it is if you just stay invested and stay disciplined towards your investment. Not making any withdrawal is actually a benefit and it is actually giving you the power of compounding under your control. So that's how SIP is also being benefited and that's how this power of compounding beautifully works. So what is the main thing which we are taking away from this slide is basically investing in a disciplined manner and just focusing on the goals in a long term will actually reap you enormous amount of benefit. It's what is a takeaway which we need to understand. And staying committed towards what you're doing. And similarly, this slide will also give you something called as how consistency can play a major role. This slide also tells you the same thing. But to simplify and put it, we're talking about 15 years time frame. Okay, so in that case, what will happen is, if you're staying for 5 years, I'm taking 15,000 as an SIP in this case, you're staying for 5 years, which gives you 15% rate of return. Okay, these are all real fund data which we have taken. Okay, so this 5 years, your investment value will be 9 lakh rupees. Okay, and you're getting 16 lakh 64,000 at the end of 5 years. You're telling me, okay, that's a normal return. I'm okay with it. That's not a very huge return. Okay. Now we are talking something like 10 years. 10 years are investing one more 9 lakhs. Okay. Because you're investing 15,000 every year, right? Now at the end of 10th year, you have invested 18 lakh rupees, 9 lakh rupees extra. But see the return of it. For the first 9 lakhs, you have got 16 lakh 64,000. But for the 10th year, you have invested 18 lakh rupees. But imagine the return you're getting is 45 lakhs. It's not 16 plus 16 which you are getting. You are actually getting 45 lakhs in return. But now if you tell me, okay, Sridevi, this is also okay return alone for me, then okay. You're staying invested for another 5 more years, which is 15,000, 15 years you're staying invested. Your investment amount is actually 9 lakhs extra, which is 27 lakhs. For an additional 9 lakhs, you must only get 45 lakhs plus the 16 lakhs amount, right? But it's not the case. You're getting a crore rupees in this case. Just by investing 27 lakhs, you're getting a crore rupees. And these are actual data for 15 years, 15K SIP with 15% as an assumed rate of return over here. This is what we call 15, 15, 15 rule will reap you a crore rupees at the end. And now just by changing a time, instead of 15 years, if you stay invested for 30 years, your investment value will not be just 2 crores, it's going to be 10 crores. So most important factor is being consistent in whatever you're doing, especially SIP investment is important. And the most important factor is timing the market is not at all necessary when it comes to SIP. Whatever time you're dedicating towards your SIP is the most. This is also a classic example which we can understand how consistency can reap you benefits. Moving on to the second rule, patience. This is actually a very difficult thing for people to do. Why? Because we'll tell you this rough thing which we can give you on a real-time basis. A particular person has invested in 2018. These 5 lakhs, okay. This is a real-time data as well. Now he has invested 5 lakh rupees. After the 2008, 2009 market crash, the amount has actually become 2.72. I panicked and I got out of that thing, okay, fund. So now I end up having loss of 2.2 lakhs, right? But instead of getting out and I'm ready to bear the risk, I'm staying invested. I'm being patient enough. So now if I'm staying invested, after the market crash, the market slowly raised. Here I'm getting only 11,000 as a profit, but I'm staying invested. I'm staying connected towards it. I'm staying committed towards it. I'm being patient. Now I'm getting 58,000 as a return. Here, if you can see, I'm getting 6,45,000 as a return. So nearly 1.45 increase. I'm staying committed. I'm staying patient. I'm getting 10.54 lakhs. Over here, I'm getting nearly 13 lakhs. Over here, I'm getting nearly 14 lakhs. But now what happens is market is suddenly crashing because of COVID. Now the market is down by 10 lakhs. As you can see, oh my God, what happened? I got 14 lakhs right before. It's going to be 9.5 lakh increase from the original investment. Now 4 lakhs I have lost. That's what you are thinking. I'm still being patient. I'm still being consistent towards my investment. As you can see, this 10 lakhs once again has rose and become 34 lakhs 73,000. What is the major key is I'm not doing anything. Just invested 11 lump sum investment of 5 lakhs. I'm just staying committed towards it. I'm just being patient whenever the market goes red also. Then you can see the benefit out of from 5 lakhs increasing to 34 lakhs 73,000. Imagine I would have withdrawn this stage, or imagine I would have withdrawn this stage, right? You might not reap this benefit of 34 lakhs. This is actually a real-time data of India's Sensex. So that is what I'm talking about. Rule 2 is being patient enough to understand even red is okay sometimes. Always seeing the green number is not okay. Even red is okay to understand. That's how you will enjoy the green when it goes up. So always remember being patient is a rule 2 which you need to understand when you're investing for a long-term horizon. When it is for long-term horizon, being patient is the key to reap the benefits which you will be getting on a later stage. Moving on. This is a beautiful thing which I love. Starting early. This is a very important thing which you can understand. For a corpus of 5 crores at a 12% rate of return, your target is 60 years, okay? Right now you're 50, you're starting now only from the scratch of your investment. You need nearly 2,17,000 every month to achieve this 5 crore rupees for 10 years. But you're starting early at your 40s itself. Then you need only 50,000 rupees to achieve this 5 crore rupees. And you're starting even more earlier. If you're 35, you've started right now, it's only half of the amount. You need only 26,000 in order to achieve this 5 crore rupees. And 5 before years also, if you're at your 30, if you're starting, you need only 14,000 bucks. Imagine you're 25 and you're starting right away to achieve 5 crore corpus at the age of 60. The amount is only 7,000 bucks. Imagine you're wasting 25 years of your life and not starting. You need 2.17 lakhs instead of the 7,000 bucks. So whenever you plan for your investment, whenever is the right time is whenever you get a paycheck, at least invest 1,000 rupees or 2,000 rupees. The amount might be very small, but starting early will definitely give you a lot of compounding benefits out of it. A lot of benefits out of it. Because the earlier you start, it's always the better with the investment because compounding will play hugely and the amount required to achieve the goal is very less compared to the other scenarios. Now, the most important rule 4 is know your risk profile. Without even knowing your risk profile, please don't blindly invest in a high risk investments because you might not have the caliber and you might not have the capacity to undergo the risk which is involved in a particular investment. Always check for the riskometer. Always understand your risk profile. Every time a Finsherpa client comes in, we give them the risk profile question or we ask them to fill and we'll understand the risk then. Based on that risk profile and based on their investment horizon only, we'll be recommending funds. We'll not blindly recommend funds. Similarly, even if you are doing it on your own, and even if you are doing it through Finsherpa, understand your risk profile and then invest it. Because it's a great matter of fact, when you do it on your own, also please understand that whether you're capable of taking that risk and invest in a high risk environment. And similarly, based on the time horizon, if your time horizon is only 2 years, please don't invest in a high risk profile investments. You always have to invest based on the investment horizon as well as the risk profile. So the rule 4 is know your risk profile. And that's it. These are 4 rules which we have already discussed. And I've talked a lot. Now it's your turn to ask if there is any questions which you need to understand, any discussions which you need to raise, or any suggestions is also welcome. You can unmute yourself. And it's about the time we close also. So we have 10 to 15 minutes of discussion time. If you have any doubts, you can also type it in the chat box or you can unmute and you can ask. I hope I have cleared and given you the introduction part of mutual funds to you. And I hope the session is also enlightening and eye-opening to you. Any doubts or any suggestion, you can just unmute and you can ask.
Good afternoon, madam.
Yes,
Good afternoon, madam. Thank you very much, madam. I'm excellent about ABCD of the mutual funds. But in clean basically, as a layman, I can understand it very easily, madam. And thank you very much, Finsherpa, and thank you very much, madam. Detail about that basics, complete start. One thing, madam, I had three doubts, madam. Regarding that, NAV, based on that NAV, we are investing that amount. CAGR, based on that CAGR, we are investing that amount. Where fund performance, you are talking about fund performance on the date of funds, plus NAV, but other CAGR for investing that, that I want some clarification, madam. First time I'm hearing that top up பண்ற மாதிரி நம்மளுடைய இதுல சிப்ல பண்ற மாதிரி the first time I'm hearing economic கேட்டதே கிடையாது. I think mutual fundsல இருக்கு அப்படிங்கிறது that is also கேட்டிருக்கேன் மேடம். அப்புறம் one more things எனக்கு சந்தேகம் the systematic withdrawal SWP சொன்னீங்க இல்லையா மேடம், அதுல exit load வருமா? Suppose a person investing that ஒரு எத்தனை இயர்ஸ் is there any locking period இருக்கா for that waiting period மாதிரி இருக்கா? Before that SWP எடுத்தாச்சுனா any exit load இருக்கா?
Okay, great sir, thank you so much for the feedback. First நீங்க கேட்ட டவுட்ஸ் வரும்னா CAGR NAV அது ரெண்டுமே டிஃபரெண்ட் ஆன திங்ஸ் நீங்க சொன்ன மாதிரி. ஓகே, so first NAV is something which is actually determined on introduction of the scheme, as well as the NAV increase or decrease is based on the fund's performances. Okay,
yes,
this is completely different. NAV is one of the factor which we can consider to determine the scheme performances. When I can compare an NAV between two funds, aptina, when the particular fund is being introduced in the same time frame. For example, if the fund is being introduced, Fund A and Fund B is being introduced before 5 years. Okay, 2020, the fund is being introduced. Both the funds are being introduced. Okay, both the funds starts with 10 rupees as an NAV. So I can at least compare the current NAV will be 25 rupees for Fund A and 35 rupees for Fund B. Then I can safely say Fund B's performance is better than Fund A. If the introduction of the fund lies in the same time frame. But I can't compare a fund which has 20 years of introduction stage and 5 years of introduction stage.
Yes.
Okay, because the NAV will be on a date very good extent, because 20 years fund the NAV will be 135 rupees or 145 rupees. But this will be stuck with 35 rupees, right? So if the time frame is same, then we can at least compare with the NAV. But NAV on the long run not going to give you as much of clarification while selecting the funds. As you rightly mentioned, CAGR, XIRR, we have different elements which need to consider on the return basis, which we will be considering while selecting the funds. So these both are different elements. But while comparison's sake, NAV and CAGR both combined only, we will be selecting the funds.
Thank you.
Second question which you have asked is SIP versus top-up SIP. I'm actually thankful that I've always given you an eye-opening thing on SIP and actually top-up SIP. Top up SIP is something which is prevalent in the market for a number of years actually. So this is actually useful when a particular person is very sure about the increase in salary, because right now when you're starting at a young age, for example, 25 or 30, your salary might not be as huge, right? You'll be only getting a normal salary. So top up SIP will play a major role wherein you increase 5% or 10% or 15% every year based on the salary increase. You can increase it at your discretion actually. When you start an SIP itself, there will be something called as a top up, which you can do 10% or 5% increase. That will be
Okay.
activated a year later. Similarly, another year later on the SIP which you are doing, another 5% or 10% will be activated, sir. That's actually a brilliant factor. When your salary increases, automatically your investment pattern will also increase. So that's how you will be benefiting a lot of compounding. Okay.
Thank you.
And the third question which you asked was this thing, right? Can you just remind me what is the third question?
That is SWP.
Perfect. Under SWP, as you rightly mentioned, there is going to be an exit load only when you are actually withdrawing before the stipulated time, sir. Okay. When I say stipulated time, what will happen is, for example, if the 30 days is my stipulated time, okay. So the fund which we have been accumulating for past 30 years is what we are going to initiate SWP, right? We are not going to touch a fund which we are immediately shifting and initiating an SWP. If we are
Okay.
immediately shifting the corpus to a fund and then initiating SWP, then for that only 1 month we will be having an SWP exit load involved.
Okay.
But the fund which we have accumulated for 30 long years doesn't have an exit load, right? So immediately SWP, if you're initiating alone, there's going to be an exit load. If not, there is not going to be an exit load. We can actually plan the funds accordingly based on the exit load percentage and exit load stipulated time for SWP, sir. So it will not collide it and we can give you the exit load accordingly. We can actually plan those stuff ahead.
Okay.
That's
Thank you,
it.
madam. Thank you.
And
Thank you, madam. Thanks.
thank you.
Thank
Thank
you,
you
madam.
so
Thank
much,
you
sir.
much.
I think there are few doubts. Ramanathan said beautiful and detailed presentation. Thank you. Thank you so much, sir. Informative session. Thank you. Thank you, Kasturi ma'am. Thank you so much. Any other doubts or any other feedbacks which you like to say, or you can also tell us what all webinars you are expecting from Finsherpa in the future, so we can prepare webinars accordingly. Apart from mutual funds, if you want something inciting about PMS and other stuff, we can do. Because twice a month we are conducting Finsherpa session. We do mutual fund 101. We call in fund managers and give them speech. We ask them to give us speech, and we also conduct market outlooks going on. So if you have feedbacks regarding that also, you can tell us. In that way, we'll also understand what is your requirement from the end. Anybody have any doubts regarding this? I'll wait for another 2 minutes. We'll close by 1:05. If you don't have any doubts, we can close the session by 1:05. If not, you can raise further questions. And this recording will be uploaded in the YouTube as well.
Sridevi, this is Rajesh here. Is it audible?
Yes, sir. Yes, sir. It's audible.
Funds allocation, how it will be happening? Based on
Yes,
this
sir.
capital?
Funds
or what?
Yes, sir. Basically, funds allocation happening information once you've onboarded. Okay, so we understood your goals. So for example, I have explained you retirement and child education goal, remember? So what we will do is we'll start with your goal digging and we'll understand what your goals are, and we'll also give you, this is the SIP amount required, this is the lump sum amount required, and you're choosing it. Okay. Once that is done, we will send you a risk profile questionnaire. You have to fill in the risk profile questionnaire. It's only basic 12 questions, sir. Once you have filled it, you will yourself understand what is the amount of risk you're willing to take. And we'll also understand this is the risk profile which you fall under. Once that is done, we have exclusive Morningstar access with us, sir. So based on your risk profile, we'll be categorizing funds. And if your SIP amount is say 30,000 to 50,000 rupees, okay. If your SIP amount is 40,000, I'm taking on an average basis, we'll be recommending 3 funds based on the risk profile. For example, I'm assuming you fall under a balanced risk profile. Under balanced, what will happen is you can go up to 60% in equity and 40% in debt. So this 40,000, we will actually split into 3 to 4 funds. Based on that, we'll be recommending 2 debt funds and 2 equity funds. This all will happen once you've onboarded. We'll send you an exclusive implementation plan and we will send you the funds based on the Morningstar analysis and your risk profile. This is how we will generally.
Thank you. Thanks.
Yes, sir. I hope I've cleared that out.
Yes, it's clear.
Thank you, sir. Thank you, Ayushi ma'am. Thank you. Interesting and a good session. Thank you. So we'll still wait with the questions, but I want you people to do one thing on behalf. Thank you so much for attending. So this is actually a QR code. If you wish to actually look into another YouTube videos for more content related stuff, you can actually scan this QR code and you can check out our YouTube channel for content access as well, for more contents which you wish to do. To see, we have an exclusive YouTube channel which has a lot of lengthy videos in explaining PMS, AIF, mutual funds, and different strategies involved. So if you're interested, please scan this QR code and you can have an access on YouTube channel as well. And if you are interested in being a part of Finsherpa's client, so we'll also reach you out through the numbers which you have registered and we'll call you. And you can also reach out through us through our websites and other stuff as well. You can call us anytime and stay connected and we can get to know about you and we can give you a financial plan and we can go forward and onboard you. So I'm going to give a minute or two time for this QR code and we'll wind up the session by 1:10 if there are no doubts going forward. You can also put it in the chat box if you have any doubts, or you can unmute it. So if there are no doubts, yeah, we can wind up the session. Thank you everyone for joining on a Saturday afternoon. That too, your presence was really valuable to us. You can kindly reach out to us through all the platforms.